Good afternoon. On behalf of the Center for Global Economy and Business, Stern School of Business, and New York University, I want to welcome you all and thank you for coming to the second David K. Backus Memorial Lecture. David Backus had very broad interests in economics that spanned theory, applications, public policy. It doesn't mean he liked a lot of the research he read in theory and application public policy. His interests were deep. They weren't shallow. They were just very broad. Dave had high research standards. He often, when people would ask him, you know, what kind of research do you value? He'd often quote, and Chris will back me up on this, he'd often quote his friend and co-author Finn Kidlin's recipe for great research. And it was, step one, ask a really important question. Step two, acquire the tools it's going to take to answer that question. Step three, take your model seriously. Step four, respect the data. And step five, and the most important step, is be humble about your results. So it's a great honor to be able to introduce somebody today that shared both Dave's broad interests across lots and lots of areas of economics and finance, but also whose research has consistently checked every item on Finn's list. Dave and I would often sit around, sometimes over a beer or two, and talk about who we thought was doing really great research in economics and finance, and invariably Darrell Duffie's name would come up, and we would kind of fall into this kind of set piece, this little comedy routine we would do. And Dave would say, you only like Duffie because you're Canadian. And I would say, no, Dave, that's wrong. I only like Duffie because he's Canadian. And we would always chuckle over that. And it's a great honor and a privilege to introduce today the lecturer for the David K. Backus Memorial Lecture from Stanford University, Professor Darrell Duffie.
Thanks everyone. It's generous of you to come out and honor David Backus. And it's a great opportunity for me to be here to honor David Backus with his wife, Marilyn Jason, sitting right here. Thank you. I think I may not have checked all the boxes on this one. The last one, the last step 5, be humble about your results. I think I can do that. The title is much more provocative than the results will suggest. It's extremely preliminary work. And we're already on the slide where it says extremely preliminary results. So the title, No Longer Too Big to Fail, let me just motivate the title, and then you can decide how much progress we've made towards that. The title refers to the kind of killer moral hazard that led into the financial crisis, that the largest banks, the so-called globally systemically important banks, were able to get very cheap credit from markets because it was widely believed by creditors, or I'll try to convince you of that from the data, that these banks were too big to fail. That is, if they failed, they would cause a crater on the economy, and that the government couldn't allow that, so that they would have to be bailed out. Now, Mervyn King is sitting right here, so I have to be very careful about what I say. The government or a central bank would do or would not do. But he can cross swords with me whenever he likes. And by the way, I hope you all take the privilege to interject, say, no, that's wrong, or ask questions. And I'm going to try to leave enough time at the end that we'll have a good opportunity to have a discussion about the topic. This is joint work with Professor Antje Berndt at Australia National University and Yi Chao Zhu, also at Australia National University. And what we're going to do is we're going to walk through the data that we can get from asset pricing, which was David Backus's specialty. He did asset pricing in a macro international setting. And I'm going to here focus on what asset prices tell us about the degree to which the creditors of the largest banks really believed that these banks were too big to fail, or alternatively, that the government would allow them to fail and the creditors to take losses. And there's a big division point there. I will try to convince you that after the financial crisis, the markets assumed that the likelihood of a bailout was much lower, okay? So that's the major message. We'll also get a look at how much that pre-crisis bailout meant in terms of the subsidy to these large banks to borrow money and get too big to fail. Okay, so just before doing any analysis, let's just look at what the markets were saying about the cost of wholesale credit to the largest banks. And I'm going to show you this at the 1-year maturity and at the 5-year maturity. So 1 year first is on the left-hand side chart, measured by the difference between the London interbank offered rate, which is the cost of unsecured credit to large banks in London, and the overnight index swap rate, which is a proxy for the risk-free rate. So that difference is a measure. It's a credit spread. It's a difference, is a measure of the expected losses on a so-called risk-neutral basis to creditors associated with lending money to these large banks. And you can see that until the crisis, this credit spread, if you can see this far, was about 10 or 15 basis points. So a razor-thin charge for cost of credit because the banks, in my view, were viewed as too big to fail. And then after, well, of course, during the crisis, the banks were immediately viewed as potentially failable, but then after the crisis, those credit spreads did not come back down to 10 or 15 basis points. They stayed up kind of in the vicinity of 50 basis points. And you might have said, well, maybe the banks were lower quality after the crisis. That would be a real failure of post-crisis regulation. It would mean the banks are less safe. I'm going to try to convince you that's not the case, and I think it's pretty much unanimous, almost unanimous, that the banks are much safer. That is, there's much lower likelihood that they will run out of capital. So we have to explain it a different way. Before we do, at the 5-year point, we're going to measure credit spreads using the credit default swap market, which at least in arbitrage-free markets, is the same as the 5-year par bond spread, the additional cost for borrowing associated with expected losses. We've measured it for both US and European banks, the 5 largest US, 5 largest European. And you can see, again, pre-crisis at the 5-year point, 25-ish to 30-ish basis points as a measure of the expected losses to creditors for lending to the largest banks for 5 years. Post-crisis, of course, it went way up, and then there was the European debt crisis. It went up again. But it settled out at a level, ups and downs, but a level far higher. Again, how could that be if you believe the story as I do, that the banks are a lot safer? Just in terms of their safety, let's take almost all the data that I have today is for the large US banks. And I'm not sure yet what the answers are going to be for the European banks. We'll see whether the resolve of governments to let the banks' creditors take a loss is actually going to work in Europe. But in the US, I think I'll convince you that it is going to work. In the US, the banks are much more solvent now than they were. In this chart, it's measured by tangible common equity to assets. In red, 2007. In blue, 2015. A lot more tangible common equity to assets. For Goldman Sachs, Morgan Stanley, Citibank, Bank of America, JP Morgan, and Wells Fargo. So at least by this measure, which is only an accounting measure, the banks are much safer. If you account for the volatility as estimated by our model of the assets and measure instead in how many standard deviations of changes in asset value the banks have as a capital buffer. So this is basically how much capital buffer there is correcting for volatility. Pre-crisis is about a 0.3 standard deviation move of assets away from failure. Post-crisis, it's varying, but a lot, more than double, possibly you could argue triple. And the Basel program, not to mention other financial regulations, have forced the banks to take in a lot more capital. They should be a lot safer, yet their credit spreads are a lot worse. Those two facts don't seem to go together. How do you apply Occam's razor? Well, one possible explanation is behavioral. Perhaps the creditors of these banks were lulled into a behavioral kind of belief that these banks just couldn't fail, and they got shocked out of their belief by the financial crisis, and they're still in shock. That's not the story that I would like to tell. I'd like to tell a more rational story, which is that the resolve of governments to force the creditors to take losses have taken a grip on the minds of creditors, at least in the United States, so that if you're lending money wholesale to the largest US banks, you really believe post-Lehman that you may be forced to take a loss. And in fact, there's a program, part of regulation, that suggests that you will take a loss through what's called failure resolution. Let me walk through that. In the European Union, it's called the Bank Resolution and Recovery Directive, BRRD. In the US, it's Title II of the Dodd-Frank Act. As implemented, it says that the holding company debt of these banks, a large portion of it, will be bailed in, meaning those creditors will be told you no longer have a debt claim, you now have an equity claim. And we'll get back to that. The main result is conditional on the bank approaching insolvency, creditors believe that they're much more likely to take a loss, that taxpayers will no longer be on the hook for as much as they were. Okay, now, to believe this story, you don't have to believe that the regulators will indeed hit the button. You only have to believe that the creditors believe that they won't get bailed out. You don't have to believe that if the regulators hit the button for failure resolution, that it's actually going to work. All you have to believe is that the creditors believe that if they don't hit the button, they'll take a loss, and if they do hit the button, they'll still take a loss. That's what we're going to be talking about. Also, reduced equity subsidies and reduced subsidy-induced leverage. Now, before I get too much further, let me go directly to step 5 on the Dave Backus program and be extremely humble. This is all preliminary. We're getting emails back and forth from Canberra, Australia nightly, and the numbers are adjusting, and they may not be the same by the time this paper gets submitted for publication. And again, we've only covered the largest US banks. We still have to fold in the European banks where the story may be different. We can control for domicile as well. Here's a preview of the kind of results that you're going to see in the next 20 minutes or so. This is moving across time. What would be the 5-year credit spread of one of these banks were its capital buffer to be held constant across time, measured in distance to default, measured in the number, that is, in the number of standard deviations by which asset values would have to fall before these banks would be put to the point of insolvency. So this bank is this hypothetical bank is of constant credit quality, and you're looking at how its credit spreads adjust across time. There's 2 reasons for adjustments. One is market risk premia are changing. Again, that was one of David Backus's big contributions to financial economics, how market risk premia are determined and how they change and what factors change them. The other big change is post-crisis, as estimated in this model, creditors believed that they would no longer be bailed out with as great a likelihood. Now, you've noticed I just backed off a little bit. I didn't say they're no longer too big to fail. I rather said that the likelihood that they'll get bailed out has dropped by quite a bit, and I'll show you the numbers. What do the rating agencies say? So let's compare the median in blue of all publicly rated firms, US publicly rated firms, according to Moody's. So the blue is the median Moody's rating of the senior unsecured debt of publicly traded firms, and in red, the US GSIB's median credit rating. Notice that the median US credit rating for the GSIBs, the big banks, has come down a lot. Is it because their capital buffers are reduced? No. It's because the rating agencies they credit the government's story that they won't be bailed out. They explicitly include in their ratings what are called sovereign uplifts. These are extra notches that they used to give to the big banks in light of the likelihood that the big banks would be bailed out if they ran out of money. Those notches they're listed for each firm, and you can look in the research provided with the ratings, how many notches of uplift were given to each bank. They've all been removed post-2013, and they were gradually removed following the financial crisis. So Lehman was enough of a shock, and then the government said explicitly, you're not protected anymore. Okay, a bit of a model. There's going to be some math coming up shortly. For those of you that need to think about your grocery list for dinner or whatever, you can get ready. That's coming up soon. But just for a few minutes, let me give you the idea of bailout versus bail-in versus allowed to go through bankruptcy in pictures, and then we'll go into the math just briefly. So this is a bank that's verging on insolvency. Its assets have fallen to the level at which the shareholders are willing to allow the debt to go unpaid. Okay, that's the condition of the bank in this picture. It has bonds in blue, deposits in green. Its assets have fallen below the level at which the firm is solvent. And in fact, it's, a lot of big banks ran at probably negative solvency, but continued to operate until it just became not worth it, or they were unable to issue enough equity to keep the banks alive. And they had to be either bailed out or fail. Lehman failed. Here's what a bailout means in our model. So when you see the numbers coming up later, you'll know what the model assumption is. What does a bailout mean? It means the government injected enough capital into this bank to recapitalize it to the point at which the unsecured holding company debt trades at par. That's our definition. We had to pick a level because, a model is an abstraction of reality. That's our abstraction, that recapitalization to par debt values. Okay, so that's how the model will work if there's a bailout. There doesn't have to be a bailout. In this model, we'll allow some probability called pi of a bailout and 1 minus pi of the alternative, which is it's allowed to fail. Failure means that a lot of the assets are eliminated by distress. And now there's even less to pay the bonds. For modeling purposes, the bank is liquidated. The bonds take a big loss. In our model, the deposits are either protected by assets or there is deposit insurance. So the model includes deposit insurance. Okay, and we'll get a little bit more detail on that in a minute. The probability pi of a bailout is the number we're looking for. And I know that there's probably at least 1 or 2 non-finance experts. So let me, in our asset pricing experts in the room, let me explain our limited ability to identify pi. This is not the actual probability of a bailout. It's what's called the risk-neutral probability. Or what practitioners call market-implied bailout probability. So it's the bailout probability that when you take expected discounted values, you get market prices. And we can't identify the statistical probability that a big bank gets bailed out because we don't have enough data to do that. Now, there is an alternative to bankruptcy, and that's called bail-in. And that's part of the BRRD and Dodd-Frank implementation in regulation. What does that mean? It means that the creditors are told you no longer have a bond claim. You now have an equity claim instead. So they will probably take a loss if that occurs, but you're not going to cause all those distress costs because you're going to open for business the next morning, theoretically. Again, whether you believe this will work or whether it will be tried is somewhat secondary to what we're able to measure. All we're going to be really able to measure is the likelihood that you'll get to this stage of not getting bailed out. And we'll have a difficulty distinguishing between bankruptcy and bail-in. Why? In both cases, the equity prices would reflect the same outcome, 0. In both cases, the bond prices ex ante would reflect roughly the same outcome, a big loss. So from looking at the market prices of equity and debt, before we get to this stage, you would have a very difficult time identifying the difference between bankruptcy and bail-in. What you could do, and what we haven't done yet, is to get different debt instruments that are differentially affected by bail-in versus bankruptcy, or bail-in versus bailout. And those do exist. There's MREL or TLAC designated debt that's distinct from other forms of debt that are market priced. Or you could do bank subsidiary debt versus holding company debt. So maybe with enough data, I could come back to you in a future opportunity and distinguish these, but I'm not going to be able to today. Today, I'm only going to talk about the likelihood of a bailout. Okay, so that's a limitation on what we're doing. There is some work on bail-in, and I've cited it in the bottom of this slide, but in the interest of time, I'm going to pass over that. Okay. So here's the mathematical model that's inspired by the work of Hayne-Leland that was done in 1994, which in turn was inspired by some work by Fisher, Henkel, and Zechner. Hayne-Leland solved this model for when a firm defaults explicitly, and I'm going to rely on those results. So this hypothetical firm has, and this is a big bank, has assets in place which are a stochastic process called the geometric Brownian motion, which means the change in assets looks like a risk-free rate minus the payout rate K on assets times the current assets in place. In expectation, that's the change in assets. And then there's a volatility term, sigma, multiplied by the level of assets, multiplied by the change in a IID process, which for today will be a Brownian motion. You can substitute with the Brownian motion a process that has downward jumps, and everything that I tell you can be redone. But today it's going to be with a Brownian motion. So that's the fluctuation of assets in place. It's a very typical risk model for assets in place for a large firm. The liability structure includes risk-free deposits of some offering some interest rate big R. You notice big R, the interest rate on deposits, doesn't need to be the same as the market risk-free rate. In case you haven't noticed, the money you're depositing in the large banks is probably not paying you a market interest rate. It's probably paying you a rate that's far below that. And that's another story for another day. So we're not requiring that. And one of the reasons the deposits are risk-free is that they're insured. For modeling purposes, because it makes the model easier, we'll take the outstanding amount of debt in face value to be a constant number P, or principal of debt. I see I misspelled principal, with a coupon rate C. Okay. And because we want a debt maturity structure, we'll take Leland's trick of having an exponentially decaying maturity structure so that the average maturity of the outstanding debt is 1 over m, where m is the exponentially decaying rate. Or equivalently, e to the minus mt is the amount of debt outstanding with maturity at least t. As bonds mature, the bank is issuing the same face value of debt in the market at the then market price. And Leland was extremely adept at solving these models. He's already given us an approach to solving this. We extend it to the case of bailout and to adding deposits, but really it's based on the work that Hayne-Leland did back in the early 1990s. Okay, so we're not going to go through all the guts of that. One calculation that's going to be coming up shortly, however, is the displayed quantity in the middle of the screen, which is the current market value of the bailout subsidy offered by the government to this particular big bank. The first factor in this expression is pi, the likelihood of a bailout. That's obviously going to be a constant proportionality on the market value. The second factor, which is that parenthetic expression raised to the power minus gamma, is the present value of receiving $1 when the bank becomes insolvent. That's based on the Laplace transform of the first hitting time of a Brownian motion on a given barrier. Here, the barrier is called V star. It's the level of assets at which the equity owners will give up the bank because they're not willing to issue any more equity to pay down the debt. The market value of equity has dropped to 0. So the first two terms are just the expected present value per dollar of exposure to the government. How much is the exposure to the government? Let's see if this pointer works. No? Okay, so V0 is the amount of assets the bank needs to have in order to reprice the debt to par. Subtract V star, which is the amount of assets at the point of insolvency. That's the size of the government injection of capital. Now, when the government injects all that capital, it gets something in return. It gets the market value of the equity in the bank because it's nationalized the bank. So the government now owns the bank. And that's happened in a few cases. We could have partial nationalization. For modeling purposes, we'll just assume that the government is the sole new owner of the bank. Nobody else, by the way, in the private market would participate because this is, by debt overhang, a negative NPV arrangement for the government and anybody else that wants to come in at the same price. The government's free to sell the equity immediately after bailout, but that's the loss that it's going to take, what it paid, V0 minus V star, minus what it received, the market value of equity, a negative number, as far as the government is concerned. Positive number in terms of the size of bailout. And so that's the present value of bailout. In a little while, like 5 or 10 minutes, you'll see how big that number is as a fraction of the equity in these banks. And what I don't have on the slide, I'll tell you in dollars. I guess this is being recorded, but I'm a little less leery of saying a number orally than I would have in putting it on the slides. For the 5 top US banks, the present value of the equities they were receiving has dropped from pre-crisis to now, to the post-crisis period, by somewhere between 200 and 300 billion US dollars in present value terms. That's not the annual subsidy, that's the present value that the model indicates of subsidy value that has dropped because the government has said, we're no longer going to bail you out, you top 5 US banks. And more importantly, creditors believed that story to at least a certain extent. That coefficient gamma is not for today. Okay, here's how we're going to identify that key number, the probability of bailout. And by the way, the assumed probability of bailout will also affect that optimal default boundary V star. So they have to be co-determined. And we'll get to that. Okay, so here's the panel regression approach that we're going to take to identify that number. We have all the credit default swap rates on all actively traded firms in the credit default swap market. That's around 800 firms, all the transactions or quotes available covering around 1.6 million observations. Now, that's a bit overkill because you have multiple observations per firm per day, but lots of transactions, essentially all the available transactions in the credit default swap market. And we're going to try to suss out from the capital structures of these firms and from the credit default swap rates that markets are charging for protecting their debt, we're going to try to suss out how these bailout probabilities are being set by creditors for the largest banks. So we're going to identify this bailout probability for each big bank on, it's marked by time, but I'm only going to try to do it once for pre-crisis, once for post-crisis. So we're going to try to identify the bailout probability for big banks, pre-crisis, post-crisis. There are still some problems to get over, which we'll get to. Okay, when we assume a given bailout probability, as I said, the assumption about, or the calculation of when the firm is actually going to default changes. The optimal time to default, or the point in time at which the market value of equity drops to 0 and the firm is insolvent, depends on the bailout probability. So the distance to default, which is the number of standard deviations, depends on your assumption about the bailout probability. That's the number, that's going to be our key explanatory variable, distance to default, for credit pricing. We're going to assume that creditors look to that solvency buffer when deciding how much to charge for credit. And then they'll add on a risk premium, which could differ for big banks and could change over time. And then we'll be, from that information, we'll be able to identify it. Here is the panel regression. Sorry, this is going to take, I promised only one bit of math. It's going to take another little explanation here. The left-hand side is what we're observing for the credit default swap rate, that's CDS in logs, for each firm I on each day T, including all the publicly traded firms. You notice that I divided it by the no bailout probability 1 minus pi. Why did I do that? I want an apples-to-apples comparison between non-big banks and big banks. So if you're a grocery firm or a consumer cosmetics products firm, you're not going to get bailed out. And when we look at your credit default swap rate in the market and we compare it to that for a big bank which could get bailed out, we have to renormalize by the likelihood that you don't get bailed out. Otherwise, the two credit default swap rates are not commensurate for the risk that you face. Getting bailed out means you don't lose any money. So it's really, if you're a big bank, if you're lending money to a big bank, you're only concerned about the likelihood that you're going to not lose money. So that's the variable to be explained. It's going to depend on a number of explanatory variables. First, a constant alpha, because you always put a constant in your regressions. Second, distance to default. The R squared, when you use distance to default, is on the order of 40%-ish. And as I said, everything I tell you, it's going to change as the paper evolves. So we're explaining about 40 to 45% before making other changes. The next factor is coefficient gamma times an indicator of whether you're a big bank or not. And this is constant across time and simply reflects our appreciation of the fact that the creditors to the big banks could be different creditors, and they could perceive a different kind of systematic risk for big banks than for other firms. So we allow them to have an add-on for big banks. We want to correct for that. The next factor are time-fixed effects, because in some prior research we showed there's a significant variation over time in risk premia for bearing any kind of public firm default risk. So we allow for time-fixed effects, capture the variation across time in risk premia. And the last control is whether or not this is a big bank after the crisis, because I've suggested that things are different after the crisis. Now, there will be a fraction of you that will be ready with the question, why do you need to control for the change in bailout after the crisis if you've already controlled for it through the bailout probability? You don't need to control for it twice. You're exactly right. And if we'd gotten the right bailout probabilities, then this coefficient phi should be 0. And that's exactly how we identify the bailout probabilities. We search for those bailout probabilities iteratively with the property that when you put them in here and here, I see I've mixed p and pi. When you put them in here and here, this coefficient turns out to be 0. So that's how we're going to identify these bailout probabilities. We also include crisis fixed effects, DSIB, which stands for domestically systemically important bank effects, and we can give you the numbers for those as well. Sectoral fixed effects among public firms. And we have some other controls, like we can control for investment grade, not investment grade, things like that. Thomas?
Just clarifying, do you restrict pi to be 0 from the non-GSIBs?
Yes.
Okay.
Pi is assumed to be 0, and there was an exception. We know that GM was bailed out during the crisis. That's an example where our method doesn't take account of the fact that the government might bail out other firms. Doesn't happen as often in the US as in other countries. So far, we're only looking at US data. Maybe a better model would allow for that. Okay. We're only going to allow pi for big banks, as Thomas just suggested, and we're only going to allow 2 levels because we want a good identification. So 1 for pre-crisis, 1 for post-crisis. Because we have so many control firms, we can do this also bank by bank. Today, again, because I'm very hesitant, and I'm not to step 5 in the Backus program yet, I'm not going to show you the numbers for the other banks, but I'll tell you orally, the effect is much bigger for the 2 large US banks that pre-crisis were investment banks. Why should that be? Well, because they had much greater leverage, and they were also, until we found out otherwise, protected from being too big to fail. And our numbers bear out that there's a much bigger drop in bailout probability for those 2 firms than for the 3 or 5 in our setting money center big banks. But I'm not going to tell you the numbers yet because I'm not confident enough to tell you the numbers, other than it's quite a lot different for those 2 firms. For now, we'll just force this number to be the same for all the largest US banks. As I mentioned, I've already controlled for big bank versus non-big bank, both through one fixed effect that applies at all time and also through this bailout probability. Those are the only 2 ways. If you suggest other reasons that big banks should be different, then you can take issue with this later. But it's been absorbed by those two things. So again, we're going to search, I just said this, we're going to search for those 2 pre- and post-crisis bailout probabilities such that When we go back and rerun that regression, we get a 0 coefficient on the post-crisis big bank effect other than through the bailout probability. So that's how we get identification. Now, OK, so let me back up a little bit before I get to the least salutary aspect of this research, which is the average bailout probability is kind of the same idea as the effect of average recovery of assets. In other words, not getting bailed out, it's a loss. Having a low recovery of assets, it's a loss. It's impossible for us to identify the difference between the expected loss associated with distress on average and the expected loss associated with no bailout on average. All we can do is difference across the crisis, pre-crisis versus post-crisis. So between these two probabilities, pre-crisis bailout and post-crisis bailout, we can only identify a one-dimensional restriction on those two numbers. What we're going to do is we're going to fix any number you like for the post-crisis bailout probability, and then we'll tell you the pre-crisis implied bailout probability. So it's, again, with apologies, here's an example. If you decide subjectively that the post-crisis bailout probability for these large firms is 20%, not an unreasonable number, but it's anybody's guess because we don't have any examples post-crisis. But if you were to decide 20%, all the data that I've just told you about would imply a 65% likelihood of a pre-crisis bailout. So substantially larger. And again, with the caveat that that number is going to change as we improve the model, but a large number relative to the post-crisis bailout probability. If you were to say, no, I buy wholeheartedly into the story that the government will not put a penny into these banks, and the post-crisis bailout probability is 0, then the implied pre-crisis bailout probability is 55%. So there's a bit of a nonlinearity in here. It's gone down by a lot either way, but the difference, the change, depends on what you're willing to assume about one of those two bailout probabilities relative to the other. Soon we're getting to the point where you can grill me with questions, so get your questions ready. We've got about 5 more minutes of me and then the rest for you. OK, this is the same chart that I showed you before, but now I'm confessing that I fixed the assumed post-crisis bailout probability at 20%, and everything else is implied by the data. And that's what you'd get for a hypothetical big bank whose solvency is always the same. Credit quality is always the same. The market is assigning different credit spreads for 5-year debt at the holding company level. This is all based on holding company debt, unsecured. Much lower pre-crisis than post-crisis on average, mostly because of the reduction in bailout probability. That's what the numbers are telling us. Now, there's also an implied effect on leverage. So if you subsidize the debt of these firms, what would you do? You don't even need to think about moral hazard. All you have to do is say, oh, the market is letting me buy assets with really cheap funding. So I'm going to buy a lot of assets. And that's exactly what the largest US banks were doing pre-crisis. Zoom, zoom, zoom. Big increases in assets. Post-crisis, not so much. For a number of reasons. Capital requirements also played a significant role. But funding costs, as I've emphasized in some other work, are critical to the capital structures of these firms. If you raise their debt funding costs relative to risk-free rates, they won't borrow as much money. So pre-crisis, the too big to fail moral hazard was really an incentive to buy a lot of assets funded with debt. That incentive has been reduced substantially. These are not model numbers. These are just straight out of the 10Ks of these firms. And this is JP Morgan, Bank of America, Citi, Wells Fargo, Goldman Sachs, Morgan Stanley, Lehman Brothers, and Bear Stearns added up. What about the market value of equity? First, just what do the accounting and market values tell us, and then we'll look at what the model tells us. The accounting numbers tell us that pre-crisis, these firms were trading at market-to-book multiples above 2. both the investment banks, or so-called dealers, Goldman Sachs, Morgan Stanley, Lehman, Bear Stearns, and Merrill Lynch, and the money center banks. Post-crisis, the market-to-book ratios dropped a lot. Why is that? Well, they're less levered. That lowers the option value of default. That's some of it. Their franchise values are possibly reduced somewhat. A lot of it, we will claim, is due to the fact that you've lost your subsidy. You can no longer get subsidized debt. That subsidized debt is worth a lot. So the next slide will show you our estimates of the model implied equity subsidies relative to the total market value of equities of these firms. And here are the numbers. They're noisy, but pre-crisis, the model implied subsidies were on the order of 75% of the market value of equity of these firms. You might be, at least I was, a little surprised at the sizes of these numbers. They're pretty big. Post-crisis, they're still there, because we're assuming a 0.2 probability of a bailout. That turns out to be still substantial, but much reduced. And I mentioned for the 5 largest US banks, the order of magnitude of the reduction in the dollar value of these subsidies from pre-crisis to post-crisis on average, a substantial reduction. Okay, last slide. We're not the first to address this problem. I want to mention a few of the papers that have addressed this issue of how much the bailout subsidy has dropped or how much has bail-in had an effect. So let me just mention a few of the papers. There's a 2016 paper by your colleague, Viral Acharya, and Anginera and Warburton. But they only looked at the small time window, 120 days around the Dodd-Frank Act. And focusing on that time window, it was an early paper, didn't give them the advantage of having this long time series, and they went at it a different way, and they found no significant effect of the Dodd-Frank Act as an event on the implied reduction in subsidies or increase in credit default swap. They were actually looking at credit default swap rates as well, or sorry, bond yield spreads, the same idea. There's a very interesting paper by Neuberg, Glasserman, Kay, and Rajan, which is mostly a descriptive paper that looks at credit default swap rates in Europe, not in the US. Because in Europe, there was a change in the triggering mechanism for a credit default swap in 2014. The new contract said, as a buyer of protection in the CDS market, you are now protected for bail-in. The old contract, which was a 2003 ISDA standard, said you're not protected for a bail-in. Well, this is kind of like what every financial economist loves. You have a difference between the two credit default swap rates tells you the market premium for bearing specifically the risk for a bail-in. And interestingly, they showed some credibility from 2014 to 2016, pardon me, 14 to 16, some credibility for this bail-in assertion that the government would bail in. But when the Italian bank Monte dei Paschi of Siena was not bailed in, or it was actually given government capital and bailed out, the market confidence implied by the credit default swap market of bail-in reversed. That is, the credibility of bail-in dropped. So that event had a big effect on the, at least according to this study, a big effect on what creditors believed. There's also a very recent paper by Atkinson, Davernat, Eisfeld, and Weil, which goes at what we're doing from the viewpoint of estimating the market value of the equity subsidy of the too big to fail by building a composite representative US bank, not just big bank, all US banks, mushing together all the accounting data for this firm, and then using a Gordon dividend discounting model and a simple Markov chain analysis of this firm, and estimating the fraction of equity value that's associated with bailout subsidy that's disappeared. And that fraction is 23%. It's a smaller number than I was showing you a moment ago, which was more like 50% reduction in market value associated with subsidies. But remember, this is a composite US bank, 8,000 different banks. So you kind of expected it to be a lower number. Completely different approach to this problem. Doesn't use credit default swap data and market pricing, uses accounting data. So that's the end of what I prepared to tell you, and now I'm going to shield myself from your interrogation. So please, anybody that has a question, Laura, you can kick it off.
All right. So I'd like to push back on what you called the behavioral alternative explanation. I want to argue it could be perfectly rational to be complacent pre-crisis and still shocked post-crisis. Why? Because agents estimate distributions. Nobody knows what the true distribution of returns for a bank is. And pre-crisis, we'd never seen a bank on the verge of default. So it would be perfectly rational. It would be wrong, but a good econometrician can be wrong, right? So it could be perfectly rational to estimate a very low probability of a bankruptcy that you'd never seen. And then post-crisis, having seen big banks on the verge of collapse, estimate a much higher probability. And once I've seen it, it's in my data set. So I'd continue to estimate big crisis levels. So this behavioral or econometrics explanation may be true for a lot of firms. And in fact, we see in equity that the skew index, a measure of the left tail in equities, went up in the crisis and never came back down. And it could be particularly true for banks, and explain your facts, if we simply believe that maybe banks load more heavily on this kind of tail risk than do other firms. So in light of that, might you be overestimating? I don't doubt that some of what you say is going on, but maybe some of that effect could be the fact that we learned something in the crisis, and that's affecting our perception of risk.
Yeah, no, that's quite possible. I remember how shocked I was when Lehman was not bailed out. I remember that weekend quite well. I'm sure it seared into the memories of many people in this room. Wow, they really didn't bail it out. Maybe they're not going to do that anymore. That's what we're trying to say here. That's what this is about. It's not necessarily about bail-in or legislation. It's about a change in the belief by creditors that this bank would not be given government capital. Now, you could say, well, maybe they updated. So they did exactly what you just said. They had a rational prior, which was based on no bank ever having been bailed out, no bank ever having failed, no bank ever not having been bailed out. Then suddenly, one of them was allowed to fail. That conditional probability that a bank would get bailed out just dropped. That's what we're trying to say.
But I guess I was claiming there were two things we learned. One is you might not get bailed out, as you said, but the other is we also didn't know a big bank would ever get that close to needing a bailout, because we hadn't seen that risk before.
Okay. I mean, we can use this, how our model identifies this, equity prices and the volatility of equity prices to infer from the data what that likelihood of reaching the point of insolvency is. That's one of our model identifying approaches.
What the skew index.
So at least as far as getting to the point of insolvency, if you go with a geometric Brownian model, or if you want to change it to a jump model or whatever, you do have the ability to estimate how likely it is that you will approach insolvency day by day from the data. So in theory, you can calculate the probability of insolvency now, and the model is supposed to deal with that. Okay. Mervyn, go ahead.
So, related to that question, but slightly different. I think you equate the phrase bailout with a government injection of capital.
Correct.
Now, in your stylized model, that follows naturally from the setup. You've got long-term debt and deposits which are protected by deposit insurance. In the actual crisis, there were, of course, an awful lot of very short-term finance provided wholesale which were not protected by deposit insurance. One of the aspects of government intervention was to replace that finance by lending. And the phrase bailouts, in practice, I think, referred as much to that as to government injections of capital. Are your results capturing the value of both of these types of intervention? and that the stylized model only refers to one, but the actual numbers you get.
Okay.
Can you comment on that?
Yeah, absolutely. So what Dr. King has just suggested is that there are liquidity issues as well as solvency issues facing this bank. Some, although not myself, would use the word bailout to describe, let's say, a central bank providing liquidity against collateral and assisting these banks from avoiding failure due to a liquidity crisis. So that's not what we're talking about here. We're talking about the fiscal authority actually injecting new capital into the bank. How would our model have to be interpreted to separate the two effects? If you take it at its face value, it would have to be the central bank or whatever the provider of liquidity is completely unfettered in preventing a liquidity-based failure and will and did, let's say case by case, step in as needed. And the only question was, where's the capital coming from? And that would be the fiscal bailout that we're talking about. That's how we would have to interpret the model. Now, whether the central bank would in fact step in and provide liquidity or under what circumstances, and there's a gray area, it was just heavily discussed by Geithner, Bernanke, and Paulson over the last few weeks. They've been all over this issue. Was it liquidity? Was it solvency? Did they have the necessary tools to use central bank liquidity as opposed to a bailout or a let it fail? And there's a gray area there. It's a great question. Yes, Thomas.
So I was trying to think about whether we can think about like an upper bound and a lower bound from the numbers you get. And on one side of the bias, I think that's what Laura was saying, which is in the data, two things happen at the same time. There's some learning and some about the true risk, and some learning about the likelihood of bailout conditional on the
Right.
risk. Now, so it seems to me that in that case, so the question is whether the equity volatility, which you has for the distance to default, is not enough to capture that. And I guess what I'm thinking about what Laura was saying was, in a jump risk model, you also need to update that. It might not show up only in the volatility of equity. So can we get a sense of learning the true risk versus the bailout on the one hand, and on the other side, for the post-crisis, if I understand correctly, your calculation is the buy. It's also about the recovery of assets.
Yeah.
That's what. But now, some of what we've done post-crisis also improve what would happen in case of a bankruptcy. So, if these efforts were successful, then that means that in other words, if we were to replay Lehman today, hopefully the recovery rate would be higher.
Higher, right.
Okay. So that bias you estimate.
That makes my results conservative.
Exactly. So that's what I was saying. So Laura's point makes them you're being too nice for the government, and the point about recovery, then in fact you want to give more credit to the government.
Yeah. So, okay, so the second part of your question we just addressed, which is if recoveries, if the regulatory program, LCR, and all of the other, TLAC, and so on, make recoveries higher, then presumably we are understating the reduction in bailout probabilities. What about, and going back to Laura's question, what about the robustness of the model to our ability to estimate the likelihood that you would reach the insolvency? So we haven't, again, early days, we haven't tested the model against other models of asset risk. If you take the model literally and you put in jumps, you would get another estimate that would be, again, subjected to the criticism that we might be confusing the learning about the likelihood of hitting insolvency from market pricing data with the change in bailout probability. And what we could do is do a range of different model types to try to convince you that most of the effect is coming from a change of bailout probability. Again, our ability to get the average bailout probability across both pre and post crisis is very limited. So if you increase asset risk, that increases the likelihood of insolvency, both pre and post crisis. And we're again unable to distinguish that effect versus the average bailout probability. All we can tell you is if you assume the technology of the bank hasn't changed a lot, then the difference between the pre- and post-crisis bailout probability is a large number. Marty, go ahead.
I think take into account the change in the definition of the credit default swap contract after the Big Bang, because that's clearly, because restructuring is no longer part of the contract.
Yep.
So I think that means that the numbers you have post 2009 will be lower. You expect to be lower than the ones before. I mean, obviously you need to have some model that predicts restructuring as one part of the whole scenario.
That's a good question. So let me address that. As Marty has suggested, the contractual definition for CDS of when you get paid has changed based on whether or not whatever firm it is getting restructured. So that there's been a change over, a migration over time in the contractual language. So we can account for that with these time-fixed effects on average across all firms. And now the remaining criticism might be, but for the big banks, the likelihood of getting restructured without going through an insolvency procedure has changed. My guess is no, because for any of these big banks, restructuring causes cross-acceleration. It causes immediate termination of the swap book and the repo book. So any kind of materially adverse restructuring that would trigger a credit default swap would instantly trigger the failure of one of these firms.
Yeah.
Other than the bail-in. Other than the bail-in.
In the context of your model, there's a clear distinction between default due to other causes rather than restructuring. I mean, this is something that's very hard to figure out.
Yeah, so that's the changes, again, changes in contractual definitions across time are accommodated in our model through time-fixed effects, which absorb also changes in risk premium. We can't separate, we don't try to separate all of that. It's all absorbed into the time-fixed effects. But the restructuring point would make a big difference in our results if you could claim that there was a big change in the likelihood that a large bank would get restructured without failing. And I would say for these banks, it's pretty unlikely that they could go through a restructuring without failing. Stein.
I'm curious, Darrell, about your thoughts about doing this across country. So in particular, you talked about Europe, kind of prior to the common deposit insurance scheme. The fiscal capacity of different countries arguably differed a lot in terms of their ability to bail out their banking system. So presumably, if you did this country by country, we could extract very different probabilities of these bailouts. And maybe also after European deposit insurance scheme, those probabilities will change again.
That's a great question. And it's going to be probably a dilemma once we fold in the European data, because we have Switzerland, which has 2 GSIBs. We have the United Kingdom, which, although it was part of BRRD, or it still is for another few months, might have more resolve than some European countries. Though I could name 1 or 2 European countries that have very large banks, which I would predict would bail them out rather than let them fail, despite the resolve of the SSM and all of the other machinery that Europe has developed around this. Let me also mention China. We're not going to get data on China, but of the largest banks in the world, the 4 largest, the first largest bank, the second largest bank, the third largest bank, and the 4th largest bank in the world are all China banks. And they have the backing of their government almost without question. And in part because they really are too big to fail. You couldn't possibly, if you were a government and you allowed it to get to the point where they were insolvent, you couldn't possibly stand aside. And in any case, the Chinese government would not stand aside. So you're absolutely right. It's going to be country by country. And I'm really interested to see what the data for Europe say, but we're not there yet. There's a question way up there.
Yeah. Hi there. I was curious, the subsidy, are you interpreting that as a subsidy from size, or is this a subsidy from systemic risk in general?
Okay, if you take the model literally, it's what the creditors believe is the present value added to their debt claims associated with government injection of capital when the firm becomes on the boundary of insolvency. That's all the model can tell us. So, we're only applying the fixed effect for the 9 largest US GSIBs in this study so far. We can do it bank by bank, or we can do all 9 banks together as I did today. We also have done it for DSIBs. Not on the slides, but let me tell you, there is also a substantial reduction in bailout probability for the domestically systemically important banks, but it's about half as big, roughly. I think I may have exhausted both the amount of time and the questions. Mervyn, you have one more.
Well, first, can I thank you for an admirably clear exposition.
Thank you.
Very Duffie-esque, if I may say so. But I want to get you to speculate about the future, because you've been comparing before the crisis and afterwards. And do you think, this is not to do with the results, but it's you introspecting on this and how you interpret it. Could you imagine that as we go forward over the next 20 years, that the probabilities would change in such a way, it's partly related to Roy's question, but complacency might step in again, and that the value of the subsidy, despite the change in machinery, could build up again? Or do you believe that somehow this is a discrete change that's permanent? That's a question of your judgment and speculation.
I'm probably not the best judge of human behavior in the room, but I think this has a lot to do with human behavior and how long memories persist. As I said, most of us have a searing memory of the financial crisis, but the median financial worker these days wasn't in the financial workplace at the time of the crisis. And government legislatures come and go, and the temptation to relax on capital requirements and relax on the resolve to make these firms failable can weaken over time. So if you had to guess on a trend, I would guess the trend is towards a gradual increase in creditors' assumption of bailout as time moves on. I'd be interested in hearing your comment, actually. What do you think?
I think we should hear from Stanford.
So, Darrell, thank you very much. Kim has asked me to give you a couple of symbolic gifts. They're not symbolic of our appreciation for your great talk. I'm sitting here and realize they're symbolic of like deep out-of-the-money options that are in your paper. Like a guy who lives in Palo Alto, we're giving you an umbrella.
We have a rainy season.
And for a guy who's an expert on financial markets and regulation, we're giving you a book written by some of our colleagues here at Stern on how to regulate Wall Street. So again, another out-of-the-money option, just in case.
I read all your stuff.
So again, please join me in thanking Darrell for a great talk. And I'd like to invite you all to head down to the first floor of this building on the west side, Gardner Commons. It's got a number? M1100. And for refreshments. And yes, down the stairs to the first floor that way. Okay, thank you very much.